began. He spoke to us about a year ago in similar circumstances. His CV it's like this deep. He hails originally from Nigeria, but he is an internationalist of significant bandwidth. His presence in this region has been longstanding. We share many mutual colleagues and friends, including the late great Frank Baldino, who was a mentor to both Osagie and me in a variety of different ways, and we miss him very much to this day. This is a guy who's been blazing a path in different kinds of ways that has spanned, you've been here like, what, 20 years now? 20, a little more than that? And he's really knit himself into the firmament of growing companies and the academic world. He sits on the board at Penn. He also teaches at the law school and at Wharton, runs a number of different seminars. They're highly sought after. He's pretty remarkable. And also, in addition to being a man of letters, he's also a man of arts. I was just telling him a story about taking my grandson to the Philadelphia Art Museum. Those of you who go, make a point of going through the Asian galleries, and you will see the exhibit that is comprised of his artwork that he very generously is now sharing with all of Philadelphia. But what's most important, I think, about his work and the things that he has done and is doing is that even in troubled and difficult times, he brings an optimistic point of view to what's possible. And I dare say that that has never been more important than it is now. And so without any further commentary, because I could be here for quite a while just describing the remarkable accomplishments of this man, I will let him tell you directly the things that he does, the things that he believes, and the things that he's committed to. So thank you for being here, and join me in welcoming this remarkable, talented man.
Good afternoon. As usual, Donna has been way too kind with her words. Thank you for coming out. It's a wonderful day. It's not snowing, and for you to spend a portion of your lunch here is actually quite kind of you. I was asked to talk today essentially about some thoughts on what is happening in two aspects of my life. I mean, the two sectors that I spend time in, venture capital and private equity, and how people in those sectors, how are they thinking about the new administration and what could happen to those two sectors. So that's going to be the focus of my talk. This is an interactive process, so I expect people should ask questions, and we can have a Q&A session, I think, afterwards. So let's start off by setting the situation. What has happened in the last couple of years with this sector? We've done very well, actually. There are roughly 800 or so venture capital firms in the States. And those firms manage roughly $160 billion. So it's a fair amount of capital that is in that sector. One of the things that makes America unique, a uniqueness that we need to maintain, and one of the things that gives us a competitive advantage is that we actually have real risk capital within our system. Many other parts of the world do not have risk capital. We do. So this is very important. This also ties in a little bit into some of the challenges and issues that we're having right now. This last year, in 2016, America, we got 6 Nobel Prizes in the sciences. I presume people in this room know what is the nationality, what is the nationality about all of those people that we got? 100% of them, all 6 of them were immigrants. 100%. Since 2010, of all the Nobel laureates that America has had in the sciences, 40% of them were immigrants. So, in my world, where we invest essentially in the sciences, we are private equity venture capital particularly in the life sciences, the things that are occurring politically have a direct and immediate impact on our ability to continue to be successful. This is what has made America unique. I noticed that Syria was on the list, and I chuckled. Stephen Jobs' father was Syrian. No apple for you. So we need to start thinking. In our world, we're already seeing the ramifications, and these are really things of great concern. With that amount of capital available to the sector, last year, in 2015, roughly 60 billion was invested in over 4,000 transactions. So it's been a good period for us, and if it's good for us, it's great for America, because ultimately these new investments, particularly in the sciences, end up creating amazing things. If you look at the companies listed on the stock exchange, a good chunk of them, I think roughly 40% of them, were founded by first or second generation immigrants. So if you took the value, the total revenue of those companies, and they were a separate country, it would be the third largest economy in the world, after the US and China. So this is good. If we're investing in the sciences, we are creating jobs and we're creating a vibrant economy that we all benefit from. In addition to creating really cool stuff that helps people across the board. It's an interesting thing. So I've just talked about the amount of capital the sector has had and we've deployed. But when you look at some of the returns, and this is a slightly different picture, and I'm talking here just about the venture capital portion, not about the private equity portion. But you can see the venture capital portion, I've had mixed returns vis-a-vis equities. Again, this is a timing issue because venture capital is much earlier in the process and you have much greater risk, and therefore you have much greater failures and therefore much greater write-offs. And the stock markets are products and companies and technologies that succeeded. So it's not exactly an apples to orange, but it's worthwhile just keeping in mind that it continues to be a highly risky segment. So what is happening specifically in the life sciences? Again, it's been a good time. A fair amount of capital has gone into that sector. Over $7 billion, roughly $8 billion was invested in 2015. And that's a significant increase of almost $1 billion plus from the previous year. So again, we continue to grow. The number of deals continue to grow. And again, this continues to convey the message that things that are happening in the life sciences are important. Things that are happening in the broader society that enables us to support the life sciences are important. What do I expect to happen this year and in the next 24 to 36 months? I think it's going to be a fair amount of harvesting. People, when you invest that amount of capital over a period of time, you start getting some exits. I think that is great. Donna earlier on mentioned Frank Borodino. As someone who has been in Philadelphia in excess of 30 years and invested in this region, I think exits are particularly important. Hopefully exits where people make a ton of money, and those people who make that ton of money, hopefully are people in the Philadelphia area. Because if they stay and they reinvest that capital or create new companies, that's the way we create a vibrant economy that focuses on the sciences. So I'm very excited about the prospects of exits. I expect that to be the case, and I'm hopeful that some of that will happen in the Philadelphia area. My firm, we are in the process, we just completed investing our last fund, and that was roughly $602 million in that fund. Over the last couple of years, we've raised and invested in excess of $1.2 billion in the Philadelphia area, all in the life sciences. We're just in the process of raising a new fund for $500 million, and we intend to continue to participate and continue to invest in this area. So this year, hopefully this year to the middle of next year, and we're going to be spending all of our time raising a new fund. No investments, but raising a new fund. But we're hopeful that we're going to start seeing some exits from our last fund, which allows us to recirculate that capital. So, on the issue of how we should start thinking about the new administration, I'm going to talk about two aspects that I was asked to focus on. The first one was the issue of carried interest. I presume everyone is familiar with carried interest, right? Let me, just in case some people are not. It's this really bizarre thing. Once upon a time, I was a partner in Pricewaterhouse, and I did corporate finance, and I did taxation. So this thing is close to my heart. It's a little bit a weird little piece of history. The concept of carried interest actually started in 1920 within the US. And the basic idea at that time was that it was focused on land and other capital investments, that it made economic sense, that if for the government to support people who were investing in capital events like land and manufacturing. And that if you held onto it for a period of time and then you sold it, it made sense for government to say, you know what, you should pay less tax on that. We want to encourage people doing that. So the genesis of carried interest is not only is it old in terms of 1920, it was really focused on physical assets, land and manufacturing. Well, over the years, really smart lawyers and really smart business folks were able to finagle it in such a way that it now covers what we do in our industry. It covers what VCs and venture capital and private equity folks do, which is that the benefits, the income that we generate is considered carried interest. A little bit different from physical assets, isn't it? And the effect of that is that it gets taxed at roughly a 20% tax rate. I say roughly because in some instances, it's a little bit less, but roughly a 20% tax rate. If you remember, when Romney was running for the presidency, this issue came up, and it was all around the question of his releasing his tax returns, and the upshot of it was that he paid, in effect, 14% tax. Now, when you compare that with the normal income tax, that is top end at around 39%, roughly 40%. So it's roughly 50% lower taxing than ordinary income. So that is the philosophical framework, this ostensible societal framework behind carried interest. We've been enjoying it. It's part of what we do in the industry. But during the campaign, at that time, candidate Trump said he was going to cancel it. Sort of close the loophole for carried interest. The reason I call it a tale of two cities, two perspectives, is that even though he said that, the Republican Congress has not shown any interest whatsoever to change that. So one of the things that we're looking at is, will there be a delta between what he said as a candidate and what he can actually get legislated while now that he's president? Will Congress go with it? It's worth noting that the chap that he has put forward as Commerce Secretary, Wilbur Ross, not only is he a multi-billionaire, but he also is in the private equity world. So he obviously is not particularly enamored of this. However, he did say earlier on that he expected to pay more taxes under President Trump. So again, this is politics. People sometimes say things that they don't intend to do. But it's going to be a very, very interesting debate. we're going to keep a very close eye on it. Frankly speaking, I have an intellectual and an economic conflict here. Intellectually, I've always chuckled about the fact that we have a society where $1 of labor that you generate is treated differently depending on who's generated it. I've always found that rather bizarre. And that's why Warren Buffett, if you recall, has consistently said that he finds it bizarre that on a percentage basis, he pays less tax than his secretary, because her income is earned income and his is carried interest. And it's a little bit bizarre. So intellectually, I can have that debate. Economically, it's great. You should pay 20%. You should pay 20% tax as opposed to paying 40% tax. So we're going to keep a close eye on that. Just to put into context the value proposition, what does this really mean? Because part of the challenge that we have as a society, and I'm hopeful that people will become more engaged now than ever before, is that we are a little bit disconnected. We hear all these words and we don't quite focus on what does it really mean. But just to put this into context, if the carried interest change did occur, there are estimates as far back as 2013 that it could be another $17.4 billion of additional revenue that comes into the government. And there are those who say, well, that's actually an underestimation, that it could be as high as $180 billion of additional revenue. So these are pretty sizable, chunky numbers. And depending on where the government ends up, it could have an impact on everyone. The other issue that I wanted to talk about very briefly is what is going on with the amount of capital that companies have generated that are technically, and I emphasize the word technically, offshore. Okay? So, again, the tax code is a very interesting piece of legislation that most people get cross-eyed on and don't focus on, but it's very important because it has a huge impact on all of our lives. And the way it's been structured right now, there are certain types of income that are considered offshore income. And because they're considered, they're deemed to be offshore, they're not susceptible to US taxation. Now, depending on who you talk to, one of the most conservative numbers of that amount of capital is over $2 trillion. That is in T as in Tom. That's a big number. $2 trillion of capital offshore. Now, there has been some, while Trump was campaigning, he made comments about, well, you know what, we're going to stop that. We're going to stop American companies having the luxury of keeping money that is technically offshore. I'm going to come back and talk about that technically offshore because it's very important. But the interesting thing is that it's not quite clear what the Republican Congress thinks about this and whether they're going to do this or not. During the Obama administration, there was a huge debate about people were clamoring on the Republican side for some kind of tax holiday. And the logic was that if you have that tax holiday, it will encourage people to bring, quote unquote, the money back. So think about it. Again, the logic was this, that, wow, we could get $2 trillion back into the economy. That would be great. That would be great for us because it's more capital that is available. Remember the numbers I showed you earlier on about how much capital was available in the venture capital and private equity world. That would more than double, triple that amount of capital, which is great because you have more money to invest, you have more technology, you have more science, and in theory, you have a much more robust economy. The Obama administration took a very firm view that absolute nonsense, that the reality is that these monies were generated, profit was created, we're talking about profit here, and if they come to the US, they should be susceptible to normal corporate tax, which is around 30-35%. So nothing got done during that period. It seems now, from what we can deduce from the Trump administration, that they are looking at the prospect of a tax holiday, but not a full holiday. So bring the money back and we will take 10% of it as tax. It's unclear whether that will be a one-time event, and frankly speaking, it's unclear whether or not they're going to be able to get it through. It seems from the Republican Congress that what they want is actually a lower tax. Bring it back and we'll do it somewhere between 8% and 10%. All right? Do I think there's a high likelihood that this kind of legislation gets through? I think so. I think both what the candidate Trump said and what the Republican Congress is indicating are relatively close. And I think there's a good chance that they're going to get that through the process, which would be a significant windfall for the economy because it would be a fair amount of cash. Now, remember I said earlier on that I was going to talk about this technical issue that the money is deemed to be abroad. The funny thing is this, tax code is very bizarre. The vast majority of this cash is in the US. Let me repeat that. The vast majority of this cash is not only is it in the US, it's been managed in the US. But it is deemed to be foreign. So no tax is being paid on it. So it's a legal fiction that turns out to be really impactful on a practical basis. Just to give you order of magnitude, Apple has roughly $181 billion liquid cash offshore. One of the best examples of how bizarre this legal fiction is that a year or so ago, Apple went and borrowed $17 billion. You hear what I said? Borrowed, rather than dip into the $181 billion in cash that it had. Because if it did that, it would have to pay tax on it. So instead, it went and borrowed $17 billion to distribute as dividend to its shareholders. I happen to be an Apple shareholder. But if you think about it from an economic perspective, it was very bizarre because that $17 billion that it borrowed was liquidity that was taken out of the system that others could not get access to enable Apple pay it out as dividend to its shareholders and avoid paying tax when it had $181 billion sitting on its books, ostensibly offshore. In our life, business, pharmaceuticals, Pfizer has roughly $74 billion. So if Apple paid tax on the $181 billion that it had, that's $60 billion of cash that would have gone into the government coffers. That has not gone in there. If Pfizer paid tax on its $74 billion, that would be another $25 billion of tax. Those are big numbers. So elections have consequences. What people decide to do, those who are around the table and who's around the table have consequences. But those are the things that we're keeping an eye on within our industry. I think there's a higher likelihood that this issue will get some movement that will let officially some of that cash to flow back into the system. I'm less clear about what's going to happen with carried interest. All right. That's all I have to say. More than glad to answer any questions that people may have.
Working? Got it. Yeah. So anyone who is streaming in, if you have a question, you're free to, I think we have Anthony's email posted, or you can tweet. You can just tweet your question, we'll pick it up and we'll pass it over to Osagie to respond to. Anyone want to start with a question? Because if not, I'm going to ask one. The prerogative of the microphone, right? So can you talk about the upcoming fund what you think the distribution of investments will be in terms of profiles of companies or licensing agreements that you might pursue?
We invest just in the life sciences vertical, and we invest across the spectrum. So we invest in things that will be considered venture, not yet generating revenue, but we also invest in things that are traditionally private equity, which is revenue generating. Our split is roughly 80% for the revenue generating private equity side and 20% for the development stage products. We used to, but right now we don't intend to invest in pure research, but we are investing hopefully in development. So that's roughly the ratio. But it's all going to be in life sciences, both biotech and pharma. We have we've done some device investments in the past, so we probably will do some device. We are unlikely to do any diagnostics, unless the diagnostic is connected with a therapeutic, either biological or pharmaceutical. So that's the plan.
And when is the close of the fund? How many closes?
It depends on how quickly we can raise the capital. If $2.1 trillion comes back to the US, hopefully we'll get a little sliver of that. It really does depend. Usually it takes a year and a half to raise a fund. So most of this year will be spent raising the fund. But if we get, we might do a first closing before we get to the total fund size.
Anyone?
One of the slides you had listed in terms of investments, biotech, animal, and then pharmaceuticals. Can you tell me a little bit about animals and where those investments are going?
We, as a firm, do not do animals and do not do agriculture. However, the industry has continued to put a fair amount of money into agriculture and animals. It's a touchy issue. We don't do it, but it's a touchy issue because most of those are some form of biologically engineered products. There are those who argue passionately that if we're going to feed 7 billion people and counting, that we have to figure out more efficient ways to create that food. And to date, biotech and science has been a major tool for getting crops with higher yield and animals with higher products. So there's a fair amount of capital that is going into that sector. And this area is actually quite involved in that. Syngenta, and other companies, and DuPont, are very big in that space. But we don't invest in that space.
Hi. You mentioned before a lot of the companies you guys invest in are pre-revenue. How do you go about valuing those kind of companies when you're going to invest in them?
Not a lot of our companies. Roughly 20% of our companies are pre-revenue. But to your question about how do you value it, one of the reasons why I love the pharmaceutical industry is there's a writer who's been looking at the evolution of man from a historical perspective. A great book called *Sapiens*. Okay, it talks about Homo sapiens. Anyway, and one of the things that he talks about is this idea of a shared illusion. Okay, and it's this shared illusions that allows us to build what we call society. Okay, so one of the most common shared illusions, for instance, is religion. We all agree on a particular view, and for that, people kill and maim each other. So one of the wonderful shared illusions that occurs in the life sciences space is that we agree amongst ourselves what are the discernible cash flow on an asset. And we have a whole bunch of probabilities of success, so probability of technical success, probability of regulatory success, probability of commercial success, and so on and so forth. So really smart folks can sit around the table and build very nice financial models that we then have a shared illusion on. And that gives us a basis to come up with valuations. Does that kind of make sense to you?
To follow up on that question, to go along with it, when you're conducting your due diligence of companies that you're considering investing in, what are some key things that you look for, and what are some things that startups should be focusing on to make themselves more attractive to venture funds?
Okay. So 3 levels of your question. Now we'll try to address each one. The first one is this. Philosophically, we have a slightly different view of due diligence than most people do. Most people think that the purpose of due diligence is to convince themselves not to do a deal. That tends not to be our approach. Our approach is that due diligence should be letting us understand the nature of the risk we're taking. So we tend to view it more as a confirmatory process than a, let me come up with a reason why I don't want to do this deal. So what that means is that we form a view very early on in the process about whether or not we want to do the deal. And we form a view as to what will be important to us as we go, no go. And so our diligence is really focused on those things. A lot of extraneous things really don't matter to us because, has been said consistently about war plans, no war plan survives the first bullet. And so for us, which leads me to the second part of the discussion, for us, the most crucial thing in terms of making an investment decision, there are a lot of people who invest in technology and in products. We do not. We actually invest in people. Because if you give me a really cool technology and you give me really smart people, every time I will take the people. Because that technology will be obsolete before you blink, and the people will create new technology for me. One of the best examples I like to give, and I've used it before, so if those in the audience who have heard this before don't answer the question, okay. I tend to ask people, what was Nokia's original business? Does anybody know? They made boots for the Russian army. And they ended up becoming one of the leading cell phone companies in the world. What is important is that the folks who ran it when they made boots for the Russian army were the same folks who ran it when it became a major cell phone company. So people, in our view, are the currency of life, and that's what we invest in. We invest in people. Which takes me to the third part of your question. What should startup companies be sensitive to? So when we say we invest in people, what does it really mean? It means that we're looking for folks that have a high level of integrity. Integrity means you tell me the truth. If you think it's crap, tell me. Because that is what I value, and that is what is worth investing in. Integrity means that you will start down a path. Here we are in Philadelphia, we decide we're going to Washington, D.C. in terms of developing a particular technology. And you get to Delaware, and you realize that, you know what, that's the wrong direction. We really should be going to New York. Not a problem. Slam on the brakes, let's have a discussion, and let's turn the car around and head over to New York. So integrity means all those factors. But it also means you've got to be smart. We have a penchant for, in what we invest in, it's a self-selected group of really smart folks. And so we like brilliance, and we like creativity. So those are the things that are important for a startup. Most startups, as you know, don't succeed. But if you get the right team, you can still back them. And they were developing an oncology product, and they end up realizing that it doesn't work on oncology, but it may work in inflammation. And that's perfectly fine with us.
So when you go about choosing who you're going to invest in, and say it's not a public corporation, how, say with a startup being private, do you go about brokering at how much you're willing to invest in that company, and then how much they're willing to give you of their company for future profits?
The beauty about the classical definition of a market is that it has three elements. Most people remember the first two and forget the third. So the classical definition of a market is you've got a group of willing sellers and a group of willing buyers. And the piece that most people forget is the third piece, which is information. And that is where the arbitrage actually occurs. The seller thinks the glass is completely empty. The buyer thinks it's overflowing. Okay? And they're looking at the same glass. But the arbitrage is that they have a difference on information. Right? So when we negotiate with a startup, that's where it gets fun. We have a view about what the technology could do or what the product could become, and that view will inform how much risk we are willing to take, and that will inform how much money we are willing to invest, and that will inform how much of the company that we need to get comfortable in taking that risk. They obviously have a view also, and that's where we have that little dialogue. Ultimately, it's important to us that those who we invest in, because we invest in people, not in technology, that they be very, very happy. My view is that if you want to pay people peanuts, you should get monkeys to work for you. Okay? So I'm a committed capitalist, and I'm very comfortable that people should make a bloody fortune. Why wouldn't they? Why would you get out of bed if you couldn't? It's silly. But we can usually find a middle ground that makes us very happy and makes them very happy. But it's a negotiating process.
Hi. So since most of your investments are in pharmaceuticals, any thoughts about the Trump administration's rhetoric towards pharmaceutical companies when it comes to regulating drug prices? And is that going to affect heavily the way that you invest?
The administration has been in office now for, 15 days? I think he's changed his position on that 3 or 4 times. So I don't like dissipating emotional energy until I have to. I'm quite sure he himself is quite clear as to A, what he's talking about, and more importantly, what he wants to do about it. There have been a lot of discussion about drug pricing. The most effective magicians will tell you that the trick of being really good is the ability to distract people. Watch the body, watch the body, watch the body, while you do something else. Okay? There is a tremendous amount of emotion around drug pricing and the like, but in the context of the healthcare system, pharmaceuticals represents roughly 15 to 16% of $4 trillion plus of an annual spend. That's not the cake. It's a piece of the cake. But that's where you get all the emotion and all the focus. Because in the past, it has been rising the fastest growth in terms of pricing. What is lost in the shuffle is that that's actually slowed down and flattened out now. But it is, politicians are in the business of getting elected, and that means watch the body, watch the body, watch the body. Part of the challenge that the administration is having with the Affordable Care Act is what do you do with it? There are 30 million people that are involved already. We don't invest in services. We do pharmaceuticals and we do biotech. So we do products. So my math is very simple. I'm not very bright. I kind of count on one finger. I would be more than glad to give a discount, 20%, for another 30 million lives potential to buy my drugs. Where do I sign? It's not that complicated. So, so from our perspective, we are ready to be calm. We think there's a lot of politics and a lot of talking going on, but the fundamentals are still that if you look at it from a dollar impact, cost benefit, pharmaceuticals is still one of the greatest deals when it comes to treating health. Vaccine costs how much, and yet it can save your life from cholera, diphtheria, and the like. Even Havoni, that people have made a lot of noise about, it's fascinating to us. This is where the emotion comes in. Hep C was a disease that was a lifetime disease, incurable. And not only was there a cost of maintaining people and treating people palliatively during the rest of their life, but they remained a vector. They could still infect other people. So when you ran the pharmacoeconomics of a patient on Hep C and what it would cost to maintain that patient for the rest of their life, and you compare it against something like Havoni, where the weird word cure came into mix, that in 90 days you could be cured, paying $90,000 for that was a great bargain. But emotionally, what people freak out on is, oh, you're paying $90,000 for a drug. Yeah, and the alternative is what? $2 million per patient per year for the rest of their lives? Really? Would that patient be able to infect other people? Really? So, but this is very emotional, so we take it very calmly on this.
Hi, I have a question. There are a lot of our students who are forming startups, and when they go before angel investors or VCs, they get the feedback that they're not investable because they are students and not seasoned. Then they don't even know if they have integrity or not because they have no track record. What kind of advice can you give to those student startups?
3 things. They should keep in mind Steve Jobs and Bill Gates. Okay? Both students, in fact, dropouts, okay, who I think did halfway decently. Okay? That's number one. Number two, if you are going to be entrepreneurial, suit up. You're going to kiss 1,000 very ugly frogs, with balls on their heads before you get your prince. And if you don't have the temperament to deal with that, this is not for you. It's not a complicated issue. It's a self-selected group. The third thing is this. The question of integrity that I mentioned earlier on had nothing to do with track record. Has everything to do with the individual. In fact, some of the greatest people with tremendous integrity are people who have started something and it didn't work. I love them. They've learned on someone else's nickel. Fantastic. But they can analyze why it didn't work and what they did wrong. And that is integrity. So it's a self-selected group, both in terms of those who are investing and those who they're investing in. And I would tell students who are entrepreneurially oriented, go for it. What's your downside? Life is a journey. You may as well enjoy it.
Any final questions? Anyone? So oh, hang on. Let me get you a microphone so everyone back here can hear.
Thank you. So the pharmaceutical markets not only depends on new innovations or new drugs, but also they are producing biosimilars out of patent drugs, which are very effective sometimes for the poor peoples. So I just want to know that venture capitalist people would like to invest that kind of stuff for student startups or.
Well, I can tell you this. So 2 aspects to your question. Let me try to address both of them. The first one about the issue of biosimilars in the case of biological agents and the issue of generics in the case of pharmaceutical agents. They're fantastic. I've been involved with generic companies, both on the pharmaceutical side and even on the biosimilar side. They're fantastic. If the drugs work and they get through the FDA approval process or a similar regulatory process, and they can be at a different price point, why not? Okay?
Which time is really a good time to communicate with the venture capital? When the regulatory issue pass, or when it will be in the process of like planning stage, like kind of postdoc or student phase. So which time is good to contact venture capital?
Okay, so the second part of the question is about investors, venture capital and the like. People have different investment theses. Our investment thesis, as I mentioned earlier on, is 80% in revenue generating assets and 20% in development stage assets. And our investment thesis does not include biosimilars or generics, even though we have done, we've invested in that in the past and done quite well with it. So my point here is this: there are firms who specialize in generics and biosimilars. And so the first thing is you've got to make sure that you find the right party that you're talking to, right? If if I don't understand Greek and you're speaking Greek to me, it doesn't help, right? So you've got to find the VC firms that are into funding biosimilars and generics. As to when you speak to them, I think it's a question of when you think you've got enough data that will convince someone to make an investment. So that would differ. That's a question of your call and the party's call.
So please join me in thanking our speaker today, who I think has laid out some really remarkable things for everyone here to think about. I mean, if I were a student or someone who aspired to be involved in life science startups, this is the guy that I would want backing me. So please think about the import of the things that you've heard today, because it will matter greatly as you pursue your individual dreams. Jefferson is committed to a big agenda. You're part of that big agenda, and we believe in you, and that's why we're here advancing the idea that all of us can be participating in a growth strategy that supports not only our institutional goals, but your individual goals, and to earn the investment caliber support from people like this really remarkable man. So thank you so much for giving them a lot to think about.
Thank you for your time.
So please stay and chat and have lunch, and any of you who think of a question, and our esteemed speaker is still here, he'll talk to you. He'll take your question even if it's private.